We now think about how gamma behaves as the option maturity gets closer to us. So let's book a trade, and let's go short for a second. Let's go short 1,000 options, price of 10.45. This costs us $10,450. We are going to go ahead and delta hedge these trades. So we'll buy 636.83 shares. I'm going to go ahead and borrow the cash, and I will borrow this money until 2021, which is the maturity of the option. And let's look first at the gamma. And we see we're short. This gamma goes down to about -19. Let's also look, just for completeness, we know what this looks like. Our value graph, we've got this frown. We're sitting at the top because we have delta hedged. And now let's see what happens as we move forward in time. So this option expires in April of 2021. So let's go forward 6 months. Again, the present value has changed because the option's worth more or less. In this case, the option is worth a little bit less. It was worth $10,450. Now it's worth $6,877. We need to rebalance our delta hedge a little bit. So let's go ahead and do that. So we're delta hedged right now. And let's update our chart. And what you see, again, the chart's moved up a little bit because we've made a little bit of money from this, but the chart is a little bit steeper on both sides. And if we look at this, we look at our gamma for a second, whereas before the gamma, the biggest gamma was at about -$19, now it's at about -$27 or so. Let's go further out in time. Again, remember this expires on the 12th of April 2021. So we're going to go really close. Let's go to April 8th, 2021. Again, we've made some more money here. That's not what's important here. So let's hedge our delta. And let's look at first the value graph. And if you notice now, compared to what it used to be a relatively smooth arc, and now there's starting to be this kink. It's almost a straight line to the left, a straight line to the right, and we're sitting at this very top. And this is what's known as being pinned to the strike. And this gets worse and worse the closer we are to the maturity of this option. Remember, we've got 4 days left. If we look at our delta, the delta is -550 or something like that shares if we go to the left. Sorry, positive 550 shares if we go to the left, if the price goes down, and -550 shares if we go to the right. And it changes pretty quickly, somewhere between around 94 or 95 up to 106 or so. It goes from this positive number to this negative number. If we go even closer to the maturity of the option, so let's go to the 10th. Again, we make a bit of money. We'll hedge out that residual delta. And we update our chart again and look at this delta. It's getting even steeper. It's changing from this positive number to this negative number very, very quickly. And we should look at our gamma. The gamma here is 0 almost everywhere, but it becomes a very, very large number, -275 or 270 at the money, at the strike. And what's happening is that we need to trade shares. Again, let's look at that delta. We have to very rapidly go from this positive delta to this negative delta very, very rapidly for relatively small movements in the underlying stock. This is known as pinned, and this is a real problem for an options trader because, again, remember, we're short these options. Let's go back and look at the value graph for a second. Right? We lose money when the market goes down, and we lose money when the market goes up. And we're being asked to sell shares, a lot of them, when the market goes down a little bit, and buy them back, a lot of them, when the market goes up. So if we change the spot, for example, to 95, the delta becomes 510. If we change the stock to 105, the delta becomes negative 489. If the stock were bouncing back and forth a little bit above 100, a little bit below 100, we would be buying and selling lots and lots of shares. But of course, we're short the option. We would be selling those shares at a low price and buying them back at a high price, and we would lock in losses every time that happened. From a trading perspective, this is a real problem. It actually becomes slightly worse because we've been ignoring the fact that it typically costs us a little bit of money to buy and sell shares. So this is a problem in the derivatives market and the options market called being pinned to the strike, when the option is very, very close to expiry and we are very, very close to the strike of that option. And what it's actually telling us, or what the real problem we're facing, is that we have a very large, in this case negative, but very large gamma, and we're not quite sure how to hedge. And as that market moves around a little above, a little below 100, the model is telling us buy and sell shares a lot. Now, typically on that last day, what a trader's probably going to do is guess. I think the market's going to go down, and I'm going to put a hedge on which is correct if the market goes down, or vice versa. I think the market's going to go up. I'm going to put a hedge on which is correct if the market goes up. And the trader accepts the loss if they're wrong, and they accept that loss as being better than continually trying to rebalance this hedge and losing money every time it happens. So that's an example called being pinned to the strike, but it also gives you some sense of the magnitude of the gamma. As we get closer and closer to the expiry of an option, the magnitude of the gamma grows larger and